Thank you very much for coming here, Alex. It's a pleasure to have you at our studios. I want to start with today's rally. Is this a risk rally? We have IMF and Goldman Sachs being the main factors to move up the market. What do you think about it?
Well, in terms of the stock market rally, definitely. I think an injection of $1 trillion from the IMF to Europe, for example, would be enormously helpful for stocks. What's interesting, though, is looking at gold, you're seeing a very muted rally, up $1, down 10 cents, and that's saying something a little bit different.
A little bit different, you said, and you have a really nice perspective among the factors that moves up or down the gold as a factor. I like the way you said gold market will be choppy for a while and very volatile, but there are some fundamental supportive factors for higher gold prices that we cannot ignore. What are they?
I think the fundamentals are twofold. One is going to be central bank buying. We saw central banks around the world buy 430 tons of gold in 2011. And that's back from 2009 when they were actually selling gold. That is a huge support in the market. If you look at China, for example, their reserves in gold is only 1.8% compared to the U.S., which is 76%. China only owns about 1,050 tons of gold. If they were to just increase that number to 3%, they would have to buy 1,000 tons of gold, an enormous amount. And if you look at global currency reserves, you're looking at about 60% of that is in U.S. dollars. So as banks want to diversify out of that, out of paper currencies, as we know the dollar has a lot of problems of its own, they might move into gold. That's one fundamental factor.
Well put, very interesting. Let's go back to China. In your report, you mentioned that there's a population factor in China. Can you tell us a little bit about that? How is it going to affect the gold price?
It's a great question. First of all, China is new to the gold market compared to, say, India. So they're playing a lot of catch-up in terms of buying. Their population, their middle class, is going to grow to 44% by 2015, according to Credit Agricole. That is a huge amount. The more money they have, the more apt they're going to be to buy gold. Gold is not just, say, something fancy you want to put on like in India where there's a cultural affinity. It's also where you want to invest. If you look at the Chinese stock market, has not been doing well. The property market is not doing well. So where can you go? Where are you allowed to invest in China where you get solid returns? And that really has been gold. In the first 11 months of last year alone, China imported about 389 tons of gold, plus they wind up producing about 90 tons of gold per quarter. That is an enormous amount of consumption for that country, and that doesn't see any signs of slowing.
Interesting. Talking about slowing and talking about the difference between China and India, let's talk about India's slowing down.
Yeah, India has been very disappointing. In the first half of 2011, they were very strong buyers, but that really fell off a cliff starting in the third quarter. So overall, say their jewelry demand was down about 3% for the year. But China and India together can make up about 40 to 50% of all gold consumption in the world. And the problem with India is that the rupee has been so weak against the dollar, inflation has been so high, and growth has been so constricted, there just hasn't been the funds. Gold's been too expensive. And we saw this week that the Indian government actually raised the import tax now on gold. So now you have to pay 2% of taxes on the amount of gold that you're bringing in, not the weight, but how much money it costs. And that's also going to put a crimp in demand there. It's very worrisome. And you could argue that China and India might wind up canceling each other out in terms of demand.
In terms of demand and price, where do you see gold prices towards the end of 2012?
Golden question, right? What I hear from a lot of analysts is it's going to be very choppy, like I said. I think that once you wind up seeing the spotlight turn to the U.S. and our own monetary problems, I mean, our M2 supply in the U.S. is $9.6 trillion. That is a ton of money into the system. Once we see that spotlight turned on us, I think that's when you're going to see the dollar come off and gold really mount a rally like we saw around August of last year. The longer the spotlight stays in Europe, that's when we have deflationary concerns. And gold does not do well in deflationary times. I mean, back in Lehman Brothers 2008 in October, gold fell 20% in 3 weeks, but then it rallied about 50% in the next year. So that's a short-term risk. But the possibility of higher prices down the road is very real. You just don't want to see a big spike again. You want to see consistent, slow, steady buying, and you want to see traders come back into the market. If you look at the COMEX, speculative net long positions are at their lowest level in 3 years. They lost 90,000 contracts in 2011. It's an enormous amount. They come back in, we see a big spike in gold.
They lost 90%, you said.
90,000 contracts.
90,000 contracts. And I want to ask you, like I ask all my guests about it, you talk to the investors and the traders also on a daily basis, and I want to get your opinion about, do they take or do they get rid of their positions in gold? Because we've been hearing that George Soros and Paulson are selling off. Do you see a trend, or is this just December positioning, portfolio changing, adjusting? What is it?
What I hear from traders is that they're hands off right now.
Hands off.
Yeah.
Okay.
They're sort of waiting to see if gold can recover from that really deep sell-off we saw in the fourth quarter. And if it can build a base around there and momentum can build, then the traders will come back in. But gold still has more to prove. So if it keeps so what we've seen perhaps is some short covering, technical trading, oversold scenario. But if we do see any kind of real correction and then finally a bottom, a real bottom, and we see those fundamentals in the U.S. really kick in, that might ignite some trader buying here, which is what we really need.
Why do we see a lagging or not an equal parallel trend between the gold mining companies? They're the stocks and the gold price. Why are they so different?
Yeah, it's a great question, and there's so many answers to that. I think the biggest one is that gold stocks are so much more risky. So they have leverage 2 to 1, 3 to 1, and that's a very scary thing for an investor. Investors also have different ways to buy. They can now go to the GLD, a proxy for the gold price, rather than invest in gold mining stocks. The biggest problem, though, has been their rising cash costs, because as gold prices have risen, so has oil, so has any input material. So their cash costs can be up anywhere 10, 20%, and the market really punishes them for that. Also, miners have production issues. We've seen Kinross actually stumble with their production costs this week, and a lot of other gold companies are lowering production guidance by even a little bit, and the market doesn't like it. They also have geopolitical issues. I mean, you look at a mine in South Africa is going to be a lot riskier than, say, a mine in Mexico, but that's something that also undermines their exposure. Lastly, a lot of gold miners, say, including Barrick Gold, the largest one in the world, has been diversifying. They bought an enormous copper company last year, so that pure play for gold is kind of hard to come by right now. So if you want it, you're going to have to go to the GLD versus a gold miner.
Very good, very interesting. I want to now talk about what you said earlier about our own monetary policies and Fed, and also we're going to go to European sovereign debt crisis too, because you said those two factors are important. Let's talk about Fed. And do you foresee any QE3 coming?
Most analysts tend to think that in the first quarter or first half of the year, we're going to see some quantitative easing from the Fed, especially if we see some sort of eruption again in the sovereign debt crisis. Greece has a huge amount of money, of debt maturing at March 20th, about 14.5 billion euros worth. If they can't refinance that, if they can't convince private bondholders to take a big haircut, that's going to cause severe trauma over here.
But do you think they will go default?
A full default?
Yeah.
Perhaps an orderly default, whatever that means. So I think we'll get some kind of deal from bondholders, but what that deal is very dicey. I think we're going to see the Fed protect the U.S. and then wind up funneling money into the system in some way. The same way we're going to see that in China, and the same way we have been seeing it in the European Central Bank.
Thank you so much. Last question. How about the earnings in the U.S.? Should we be optimistic, or should we?
All earnings?
Are they going to reflect are they going to be reflected on the prices on Wall Street?
I think it's going to be really choppy. I think it's going to be company specific, not sector specific.
Thank you very, very much for coming. It was really interesting. Those comments were very valuable.